In 2018, the luxury e-commerce company Farfetch IPO'd to great fanfare, with its share price surging more than 50% on its first day of trading. While e-commerce adoption has increased rapidly over the past decade, one category where adoption is lagging is luxury fashion, with the vast majority of purchases still done in-store. Farfetch promised to be the leader in this nascent but rapidly growing market. At its peak in 2021, its share price reached $73 per share, almost quadrupling its IPO valuation just 3 years prior. This gave it a market cap of $24 billion. Fast forward to 2024, and Farfetch has lost 99.9% of its stock market value, and recently announced its intention to appoint a bankruptcy administrator. The South Korean e-commerce company Coupang is buying Farfetch's remaining assets out of bankruptcy for $500 million, which is about 2% of the company's peak valuation. In this video, we'll look at how Farfetch built the world's largest luxury e-commerce platform, and how it all came crumbling down. This video was brought to you by Bellroy, an Australian brand which makes some of the highest quality personal accessories I've ever tried. As a YouTuber, I have the benefit of being able to work from anywhere, so I've been using Bellroy's digital nomad kit to help carry around my tech when I travel. My favorite part about Bellroy is its minimalism, which makes it quick to pack and organize. For example, the laptop sleeve has a magnetic lip, which protects your laptop from falling out and is way faster to close and open compared to zippered sleeves. The tech kit is hard-shelled, so it'll maintain its shape and will keep your gear safer than a softer tech pouch. It's got a pen holder and 2 pockets that you can use to hold things like a wireless mouse and a power adapter, and straps to hold cables. The coolest part is the hidden magnetic compartment, where you can hold an external hard drive or portable battery. Both the sleeve and the tech kit are made from woven polyester and nylon, which are made from recycled industrial offcuts in water bottles. Discarded nylon can take up to 40 years to decompose, while plastic water bottles can take up to 400 years. These recycled materials perform just as well as virgin materials, but are obviously way better for the environment. So if you're looking for travel gear or a whole host of other urban minimalist accessories, make sure to click our link in the description to get 10% off anything on bellroy.com. And now back to the video. Farfetch was founded in London in 2008 by the Portuguese entrepreneur José Neves. At the time, the world was suffering from the global financial crisis. As unemployment rose, less people had disposable income to spend on luxury fashion, causing sales to decline. Some of the hardest hit companies were so-called luxury boutiques. These were small, independent stores who sell an assortment of luxury brands, which they can source from wholesale distributors. Jose realized that these boutiques could benefit tremendously if they could list their unsold inventory online for anyone in the world to purchase. So he created Farfetch.com, which you can think of kind of like the eBay for luxury goods. For any stock a boutique can't sell, they give it to Farfetch, which will photograph it and list it on their website. If the product sells, they'll pay the boutique the proceeds minus shipping costs and a roughly 30% commission. If the product doesn't sell after a period of time, Farfetch sends it back to the boutique. From the beginning, Farfetch operated an asset-light business model. They didn't own any inventory, and they didn't own their own distribution centers either. They outsourced most of the logistics to third-party providers. On the surface, this sounds like a great business model. They basically just have to operate their website and app, and collect a sizable 30% commission from every sale. Of course, the boutiques would much rather sell their product in-store and forego the commissions they have to pay to Farfetch. The only way for Farfetch to have a value proposition is if they can sell items much faster and more efficiently than a brick-and-mortar boutique can. To achieve this, Farfetch needed to attract many thousands of active buyers to shop on its platform. One of the main value propositions of e-commerce is the large selection of products. For example, if you live in a small town, there may not be any luxury retailers within a reasonable distance, so an online marketplace is a very attractive proposition. Whenever Farfetch could get their hands on products from top-tier luxury brands, they generally had very little problem in selling it. Over the following years, Farfetch expanded rapidly. On the supply side, they focused on signing up as many luxury boutiques as possible to start selling on Farfetch.com. On the demand side, they spent huge amounts of money to sponsor numerous fashion influencers on social media. Secondly, they invested heavily in direct response digital advertising, such as Google Search and Facebook ads. Finally, they opened a small number of brick-and-mortar locations. While these stores generated a very small percentage of their overall sales, opening physical locations is a good way to build brand awareness. By the time they went public in 2018, their revenue had grown to over $500 million. While they were still losing money, they were growing rapidly, and their unit economics appeared to be sound. The IPO was a huge success, with the stock price rising 53% on the first day of trading. One of Farfetch's earliest venture capital investors, a man named Frederick Court, wrote a blog post explaining why Farfetch was the perfect venture investment. It had everything venture investors wanted to see: a large and growing market, a highly differentiated model, significant barriers to entry, a win-win proposition for both sides of the marketplace, and an attractive financial model with strong unit economics and no inventory. When the pandemic struck in 2020, this was a huge windfall for Farfetch. Stay-at-home orders made it impossible to shop at brick-and-mortar stores, forcing people to shop online. And thanks to government stimulus programs, consumers had more disposable cash than ever. In 2021, Farfetch's sales surged to a record $2.2 billion, and its market capitalization peaked at $24 billion. However, success would prove to be short-lived. One of Farfetch's biggest problems was sourcing supply. Most of the large luxury fashion companies like LVMH and Hermes didn't want to sell their product on Farfetch. They much preferred to sell them at their own stores. Consumers can also order products from the brand's own website. Large established luxury brands have no need for a middleman like Farfetch, which charges a 30% commission. Secondly, Farfetch often discounted its inventory when it wasn't selling quickly. These discounts were funded either by the seller, Farfetch, or a combination of both. Many top-tier luxury brands don't like their products to be ever on sale, as this cheapens their brand image. The only real benefit to selling on Farfetch is access to their base of active consumers. Large established luxury brands already had enough mindshare to make this unnecessary. Consumers come to the brand's own stores and websites on their own. Unable to source product directly from top-tier brands, Farfetch had two main sources of supply. Firstly, they were able to source product from smaller, less well-known brands. Secondly, they could source product from independent boutique retailers, which buy their product from wholesalers. Importantly, independent boutiques only used Farfetch to sell unpopular inventory, which they found difficult to sell on their own. As Farfetch grew, they had to sign on more and more sellers. At the peak, they sourced supply from over 1,000 boutiques and small brands. Dealing with so many small suppliers is a huge administrative burden, necessitating thousands of salespeople, accountants, IT workers, etc. Furthermore, in recent years, many of the large luxury brands have focused on increasing their direct-to-consumer sales and decreasing their reliance on wholesalers. By cutting out the middleman, they can achieve higher profit margins, and it gives them more control of marketing and pricing. As a result, the independent boutiques who sell on Farfetch have less and less access to top-tier brands. Today, many of the most sought-after brands are completely unavailable on Farfetch. This greatly decreases the value proposition to consumers. All the way back in 2019, Farfetch knew this was a problem, so they spent $675 million to acquire the New Guards Group, a small fashion company which owns brands including Marcelo Burlon, Palm Angels, and a few others. With this acquisition, Farfetch could ensure a steady flow of supply from these brands. While this was probably a good idea, it wasn't really enough to move the needle. By 2022, sales of their owned brands only represented about 10% of their gross merchandise value. Now let's look at Farfetch's financial performance in 2021. This is the year when their stock market valuation peaked. They generated $2.2 billion of sales, but their gross profit was less than half of that. A sub 50% gross margin might sound surprisingly low for a platform company that takes a 30% commission and no inventory risk. There are a couple of reasons for this. Firstly, about 15% of their revenue is shipping and handling. They outsource shipping to third-party logistics companies and pass the cost onto the consumer with zero margin. Secondly, about 10% of their GMV is from their own brands. For these sales, the entire purchase price is recognized as revenue instead of just the 30% commission. This naturally drags the gross profit percentage down. Finally, they incur significant costs related to customer service, processing returns, etc. This left them with about $1 billion of gross profit. Almost a third of that was eaten up by marketing expenses. The lack of top-tier brands on Farfetch decreases the value proposition to consumers, leading to high customer churn. They have to compensate with aggressive marketing to bring in new customers. They also had close to $600 million of general and administrative expenses. This large corporate overhead is necessitated by the complexity of sourcing supply from over 1,000 independent boutiques. So despite being an asset-light business with a 30% take rate, Farfetch still managed to lose $460 million in their best year. In 2022, their revenue growth slowed to a crawl, and in the first half of 2023, revenue declined for the first time in the company's history. Previously, investors were willing to fund Farfetch's losses because its revenue was growing. Once revenue growth stopped, investors finally lost patience, and the stock price fell from a high of $73 to just 2 cents. In January of 2024, they officially ran out of cash, and a bankruptcy administrator will liquidate their assets. The South Korean e-commerce company Coupang agreed to buy what's left of Farfetch's assets for $500 million, which represents about 2% of its peak valuation. Farfetch shareholders are unlikely to receive any of this money, as the company has more than $500 million of debt that has to be paid first. It's unclear what Coupang plans to do with Farfetch's brand and assets. They're a mass-market retailer similar to Amazon. They only have logistics infrastructure in South Korea, which represents a tiny percentage of Farfetch's customer base, so it's hard to think of many synergies. This all begs the question, why was Wall Street so wrong about Farfetch? It was considered to be one of the most innovative companies in the fashion industry and reached eye-watering valuations. How did they go bankrupt just 3 years after their stock price peaked? Let's go back to Frederick Court, the venture capitalist who called Farfetch the perfect venture investment. He said they had significant barriers to entry, a win-win proposition for both sides of the marketplace, and an attractive financial model with strong unit economics and no inventory. With the benefit of hindsight, we can see that almost all of this analysis was wrong. In terms of barriers to entry, Farfetch had almost none. They operated an app and a website. They didn't even have their own distribution capabilities. All of this was outsourced to third parties. This is extremely easy to replicate. Pretty much all of the major luxury brands have their own e-commerce websites where consumers can buy from them directly. There's no need to pay Farfetch a 30% cut as the middleman. So how can it be considered a win-win for the brands? Silicon Valley has always loved the idea of an asset-light business. The idea is that you can just code up some app, and this will turn into a billion-dollar business. The most important thing in the fashion industry is the clothes themselves. The top brands have built up their heritage and mindshare over many decades, if not centuries. That's the real barrier to entry and something Farfetch could never achieve. Having an asset-light business model is great, but you need people to use your platform. And if you don't have the top brands that people want, it's very difficult and expensive to build and maintain a large customer base. Alright guys, that wraps it up for this video. What do you think about Farfetch? Let us know in the comments section below. As always, thank you so much for watching and we'll see you in the next one. Wall Street Millennial, signing out.